Hey, hello, and welcome to MGO's first video market update of 2024. Hard to believe we're almost through the first quarter. I'm Paul Archowski, along with Michael Moskal, Brad Wingler, and Justin Petrus. And we want to thank you very much for joining us again. And with that, I'm going to turn it over to Michael.
Thank you, Paul. And hello again, everybody. And a happy Fed Day, by the way. And, the Federal Reserve met today on interest rate policy, which they do 8 times a year to try and decide whether they want to raise interest rates, lower rates, or keep them the same. And today the conclusion was to keep them the same, although they did announce that they still expect that they're going to be cutting interest rates by 3 times by the end of 2024, which definitely impacts the economy and investment markets in your portfolios. So today we're going to go through a few things. One is talk a little bit about the Magnificent Seven stocks. Those are all the stocks that we know and love that are near and dear to us. We use their products. Apple, Amazon, Nvidia is, of course, the new favorite of the markets. Tesla, Google, Microsoft, those stocks. And last year they dominated the market, and we're going to talk a little bit about whether that's happening this year and whether it's going to continue to happen. The AI revolution, artificial intelligence, has become the big buzzword in Wall Street and investment markets this year. And we have a very positive view on AI, which we'll talk about. Interest rates, we just mentioned about the Fed. Will rates go lower, and what does it mean for your investments? And then, of course, 2024 is an election year, and we'll get into that a little bit. Not politics, just about the economic and market implications of it. Our market scorecard, taking a look at how the markets have performed so far this year, very positive for stocks and not so positive for bonds. So we look at the New York Stock Exchange Composite Index, which is actually all stocks that are listed on the New York Stock Exchange, as a better barometer of what the stock market is doing. And that's up 6.7% for the year. Last year was up almost 11%. Bonds, I just mentioned, were negative. They're negative 1.5% for the year. And the reason that way is because interest rates have gone up a little bit this year. Bonds were up 6% last year. Our MGO equity ETF portfolio, which is our flagship portfolio that many of you are invested in, that's up 6.3% this year. We've done pretty well this year, again, being overweighted in some of the high-tech areas and artificial intelligence areas. Last year, we were up 23%, by the way. We had a good year last year also with the equity ETF. And then some of these other indexes you hear about on TV and read about, the Dow Jones Industrials up 3.8 for the year. S&P 500, which is sometimes used as a proxy for the stock market. We've kind of gotten away from that because almost 40% of that index now is invested in technology stocks. So it's kind of hard to call it a representation of the whole stock market, generally. Dow Jones Global ex-US is foreign stocks that are up 3%. There are certain sectors in that global area that are not US that are doing very well, Japan, France. And that's an area we're looking at actually increasing as 2024 goes on here. And then other areas of the markets, gold up 4.5% for the year. Interestingly enough, gold's actually outperformed the Dow, if you want to use the Dow as a stock market proxy, the last 20 years. So gold has a really pretty positive chart the last 20 years for performance. Oil's up 16%. And, Bitcoin's back. Bitcoin's back. Nobody wanted to talk about it back in 2022 when it was down 78%. But it's up 65% this year on the heels of being up. Yes, that's a real number. It's 156% in 2023.
Hey, Michael, I'll jump in on Bitcoin. There's kind of some things going on with Bitcoin that I think have kind of reinvigorated it. So if you notice there's been a lot of talk over the past several years about allowing for Bitcoin ETFs. And the SEC finally allowed for 11 different Bitcoin ETFs back in January of this year. So that created a lot of excitement, and it made a lot of availability to the average investor for cryptocurrencies. So I think that probably helped to help to boost the price of Bitcoin. But then there's also been some big buyers of Bitcoin. So there's a company called what's the name of that company? I can't think.
MicroStrategy.
MicroStrategy, that's it. Mm-hmm. So MicroStrategy, which is actually a software company, they've actually done 2 debt offerings this year and used that debt, the proceeds from those offerings, to buy more Bitcoin. They actually have over $15 billion in Bitcoin on their balance sheet at this point. So they're not only buying it, but they're leveraging to buy more Bitcoin. So it's been interesting to see how much the commitment to Bitcoin is in some places this year. So
Yeah,
that
is excellent points, Brad. Really, they are, because once Wall Street announced that they were going to, once they got approval, the SEC had approved Wall Street to launch ETFs that were Bitcoin ETFs, and that's been in the works for 3 or 4 years, but they finally got the approval more recently. Once we found out the Wall Street money machine was going to be able to sell ETFs to the customers, it's like, okay, that's probably going to push the price of Bitcoin up. We talked a little bit about, and I talked, about the Magnificent Seven stocks. Again, you look at those big stocks: Meta, Amazon, Apple, Microsoft, Google, Tesla, Nvidia. They dominated the market last year. Almost all the market gains last year were from those stocks, and that's the right side of the charts here. They were up collectively 71% last year, while the other 493 stocks in the S&P 500 last year were up 6%. It was just an enormous difference last year. That's a very unusual thing to happen. We have seen it happen before. The last time we saw that happen was in the late 90s, when you had some of the big .com stocks that were dominated the markets back in those days. And it never lasts, so you got to be careful and not just sock a lot of money away just in a few stocks. We want to stay diversified. We're looking for broadening out in 2024 besides just those Mag 7 stocks, those big stocks. And already we're actually seeing it. Justin, what's the sector performance for S&P this year?
For the S&P, we're up 8.57%. And then looking at the individual sectors here, communication services is up 14.22. Information tech is up 11.96, and energy is up 9.98.
How about the couple more after energy?
Energy, then we have financials up 9.14, industrials up 7.88, and healthcare 6.97.
Yeah, so we're seeing a broadening out. And yes, the Magnificent Seven / AI kind of stocks, the tech stocks, those high tech stocks are doing very well this year, which is great because we're overweighted in tech stocks in our portfolios. And we'll remain that way for now, which has helped you as customers with your portfolios. But there is a broadening out going on, which is good. So other sectors are starting to participate. And in some of the memos we've more recently sent out, we've talked about some of those sectors, the energies and the healthcares and industrials, that probably as 2024 goes on, and it may not be too long before we start actually investing more in those areas. Earnings estimates also support that case. For the first quarter of 2024, that 38% number that you see in the blue chart there, that's the Magnificent Seven earnings for the first quarter. Everybody else was at -2, 493 stocks in the S&P 500 out of the 500. But as the year's going by, the estimates are expected to start to even out here. So by fourth quarter of 2024, it looks like we're having earnings growth that should be even with the Magnificent Seven stocks and everybody else. So that also supports the whole broadening out theme that we're taking for 2024. Love this chart. This is a great chart. So on the left side of the chart, you see the top 10 stocks in the S&P 500, and those are the ticker symbols that we see there. So I'll just read through them. In 1999 and 2000, these were the best stocks out there. Everybody wanted these stocks, and they bought these stocks. Microsoft, GE, Cisco, Walmart, ExxonMobil, Intel, Lucent Technologies, IBM, Citigroup, the bank, and AOL. Those were the top 10 back in those days. And those were the behemoths. Those are the big Magnificent Seven stocks. Those are 10, but those were the big ones back in those days. And interestingly enough, out of those 10 stocks, there's only 3 of them that today are bigger from a market cap perspective, what they're worth, than they were back in those days. And 2 of them are not even around anymore, stocks. Lucent and AOL went by the wayside eventually as the years went by. The 3 that are bigger, by the way, are Microsoft, Walmart, and Exxon. But all the rest of those stocks are smaller. So if you put money in those stocks, 24 years ago, you haven't made any money essentially. So we look at this, and the reason why this makes a difference, because again, when we look today at the top 10, which is on the right side of the page, the Apple, Microsoft, Google, Amazon, and so on, they may not be the top 10, 10 years from now, or even 5 years from now. So it does behoove us to be looking elsewhere for potential returns that are down the road. Okay, battle between the Fed and Congress, and we see this already happening this year. Are they going to cut rates, not cut rates? I just said that earlier. The Fed today said that they think they're going to be cutting 3 times, but they don't have to do that. That's what they think they're going to be doing. And, we certainly look at this and we know what Congress probably wants, because, this year again is an election year, 2024. So we block our calendars out, by the way, because twice a year, Jay Powell testifies in Congress, and he testifies one day at the House Finance Committee, and then he goes to the Senate Banking Committee and testifies the next day. And the members have a chance to ask him questions and give their comments, what they think should be happening. And if you listen to the last one that was done a couple weeks ago, they put a lot of pressure on Jay Powell, who's the Fed chair, put a lot of pressure on him about cutting rates, because the story that they tell, which is true, they tell about how their constituents in their districts can't afford houses because mortgage rates are at 7%. Their small business owners can't afford business loans, rates are too high. So by and large, they were putting a lot of pressure on Jay Powell and the Fed to be cutting rates to try and get things better, economically in their districts. So at the end of the day, the Fed is supposed to be an independent agency, but I think really from our perspective, starting with Alan Greenspan back in the 90s, they kind of started not becoming that way, and they started becoming much more influenced by the political structure. So our guess is that the Fed will fall through and they will start cutting rates. Now, when will they do that? Sooner than later, probably. They certainly don't want to do it a month leading up to the election because it looks too political. So our guess would be in the next 60 days or so, you may hear the Fed start talking about, they're going to start cutting rates. And Jay Powell's already started setting the table for that, because guys, what has been the Fed's inflation target for years and years and years? What have they been saying that they want to get? 2%, right?
2%.
2%. Every time someone asks them a question, 2% inflation target. We want inflation 2%. And of course, when inflation was at 9%, they were raising rates to try to slow things down, and they have gotten inflation down. Inflation is running at about 3.1% right now. So it's still above their 2% target.
Yeah, but the language has changed now. So, they want to, if we're on the way to 2%, then we can justify cutting.
Paul, that is right on, because that's exactly what Jay Powell said in the testimony, right? Yep. It was the first time we heard that. He hasn't said that in years. But all of a sudden he says, well, maybe 2% is not our target. Maybe as long as it's starting to come down to those levels or close to it, which again, from our way of looking at it, right, Paul, that he's setting themselves up for cutting rates.
Yep.
So that if inflation is still at 3% in June, they're going to cut rates anyway, because you say, well, it's coming down towards the 2% level. And by the way, just to kind of tie that up, lower rates normally do well for bonds, because as interest rates go down, what happens to bond prices?
Go up.
They go up, inverse relationship. So as rates go down, bond prices go up. So if the Fed does start cutting rates, that should be good for our bond portfolios, to have a positive performance there. And again, historically, when they cut rates, it also has been good for stocks. Now, some stock sectors perform better during rate cutting cycles than others. And this goes back to 1984. There's been 8 episodes of the Fed cutting rates, not just one time. This is a Fed cutting cycle, in which typically the cutting cycles are going to last 12 months, sometimes longer. But certain sectors have performed better during these cutting cycles than others. And you can look on the left, on this graph, what's above the line are the positive performance relative to the S&P 500 during rate cutting cycles, which we see at the bottom of that are healthcare staples, energy, discretionary stocks, industrials. Those tend to be the areas that perform better. And then the industry in the sectors that perform worse than the S&P, doesn't mean negative performance, by the way. It just means that they're underperforming the S&P, would be information technology, financials, utilities, materials. So we'll see if that occurs during this rate cutting cycle. We have one little caveat with this. And what is that, guys? We talked about this a little bit. You know, the caveat that we have this time with the Fed cutting rates.
Normally, the Fed's cutting rates at a time when the economy is contracting, but now they're cutting rates at a time where the economy is strong. So it's not typical.
Yeah, for sure, Brad. You know, so this is an unusual time because actually it's never happened before. You know, the Fed has always embarked upon a rate cutting cycle when the economy is weak, starting to go in recession or in recession, or something else is happening, such as the stock market's crashing or something really, you know, quote unquote bad is happening out there. The Fed jumps in and starts cutting rates to try and juice things up. And this would be the first time if they do start cutting rates that they're cutting into an economy that's actually growing and a stock market that's actually at all-time highs. It just hasn't happened in the past before. And it doesn't mean anything bad. You know, it just means that it makes us question a little bit, you know, this chart that we're looking at right now, and to say we want to be careful and not just go wholesale and go all into healthcare and staples and energy and get out of information technology. We just want to be a little careful and kind of see how it plays out. And, you know, probably more like, you know, dipping our toes in the water when it comes to these other sectors and putting more money into those sectors. And this supports what we just talked about. You know, right now, there are certain areas that are very expensive in the market, and it does not mean they don't get more expensive. And there's certain areas that are cheap that we're looking at investing, you know, more money into, because cycles change. You know, cycles don't always stay the same. One sector doesn't always stay on top forever. You know, there's always cycles that happen that cycle through. And, you know, some years and some cycles, 3-4 year cycles, you may have information technology outperforming, and then you may have the consumer discretionary, and then you have energy outperforming for 3 years, and those cycles happen. And, you know, our research that we do is to try and gauge, you know, when those cycles are going to happen as best we can. You know, it's really difficult, of course, to pick the tops and bottoms of things, but we've been pretty good at being able to see sectors that certainly are cheap and that are likely to do better in the next cycles. Election years, presidential election years, which we're in right now. What happens? What does the stock market do during those years? Positive performance, you know, for sure. All presidential election years, the stock market has done 11.3% on average, and that goes back to 1928. So that goes back for, you know, almost 100 years. So those are good numbers. What would you prefer to have? The incumbent stay in or a new president elected? This is not a political statement, just strictly from stock market perspective. You'd like the incumbent to win because the returns have been bigger over time. On average, doesn't happen every time, but on average, when the incumbent gets reelected, the market's up 13.4% during that year. And when a new president is elected, it's 9.3. Although we have to question and say, is this really a time where you'd have a new president, or is this a new old president or an old new president? You know, this is one of those unprecedented times. I think the last time that we had actually a ex-president running for election again, I think it was 1956. I think I'll go back and check, but there's not been there's not been too many times in history we've had this happen. So it is pretty historical. But generally speaking, presidential election years are good for the markets.
Yeah, hopefully we'll have either way an incumbent president, so we're going to get good returns for the year.
Right, Paul.
Positive, yeah.
Yeah, I guess you could make the case, right, that both whoever
Both
wins
incumbents.
is incumbent president.
Can't lose.
I like your positive attitude, Paul.
And then longer term, you know, we've been talking about short term, 2024, and even shorter than that. You know, we do get questions from people asking, you know, what do you see longer term? And I guess it depends on your definition of longer term. But, you know, our longer term would be looking out over the next 5 years, even 10 years, even longer with some of these cycles that are happening. You know, and the way we look at things, we think that there's going to be higher interest rates over the next cycle, you know, longer term cycle. And it doesn't mean 10% interest rates or 15% like we had back in the 70s and early 80s. It just means higher than they were in 2009 to 2021, where they were almost zero. So we think it's very, very unlikely that we're going to have a whole cycle worth of zero rates again. Doesn't mean the Fed may not at some point try to push them down there temporarily to do something, but it's going to be very difficult to keep rates at zero without stoking inflation, without stoking inflation like they did last time.
And if you look at it historically, I mean, rates have, on average, if you go way back in history, they've averaged about 4 to 5%. So we're kind of in that range of what historically is average. The 0% was really the abnormal, rates that we went through that whole period. So we're closer to probably what's historically normal now, and probably stay in that range.
Yeah, Paul, that's a real good point, because Warren Buffett even said back during that 2009 to 21 era, he said, we're seeing interest rate policy near 0%. He says, we haven't seen that. He said 3,000 years of interest rate history. And I guess he supported it by going back to the Babylonians or whatever. He went back all that time and said, yeah, you can go back and see what they were lending money at rates, what kind of rates that they were lending money out during those times back thousands of years ago. He said, we've never had zero rates like that, because it's not intuitively correct, right? I mean, if you're going to loan money to somebody, you don't loan it at zero, because you're taking risks. They may not pay you back. They have your money for a time. So there's always been some kind of consideration. So you're right. That's not a usual time. And I think you're right that the rate is 4 to 5% seems like that over long periods of time, like that's the standard kind of interest rate.
I think that also really helps our clients' portfolios, because we build these portfolios, and that fixed income portion of the portfolio wasn't returning very much. We were lucky if we could get 2%, 3% on that fixed income portion. But if we can get 4, 5, 6% on that fixed income portion, it really helps clients' portfolios, and it really also helps the saver, the person who's just socking money in the bank or in a money market or wherever. They're finally getting a little bit of yield on that money. So the higher for longer it can be kind of a good thing for a lot of people.
Yeah, for sure. And that's rates being at those levels have favored savers, which it kind of should, because usually the savers are older investors who probably shouldn't be taking excessive risk in their portfolios, like my parents. Here it is, 88 years old, and when rates were at zero back in the last decade, it was more difficult to try and generate performance without taking more risk. So when rates are at normal levels like they are now, I can have for them, much more of their money invested in more conservative investments, which it should be at those kind of ages. So you're right, Brad. Deglobalization is another longer term theme. Really since the wall fell, if you remember that back in 1989, Mr. Gorbachev tear down this wall, and then they took a sledgehammer and actually it did tear down the wall. So they, that sort of signified, and this whole globalization, it kind of kicked that whole thing off, where countries were not fighting as much with each other, and we're working with each other more economically. And when you were looking for if you were a company looking for places to make your products, you started having products being made, overseas, if that's where it was cheaper to make it. So now there's arguments for and against that, of course, but it did help as far as prices were concerned with goods all around the world for consumers like us, when we consume things and buy things, kind of like the Walmart revolution. When things were being made cheaper overseas and we're able to buy things cheaper, it helped people also to have more money, discretionary money, to spend on other things. So that really was the case, really, from 1989 up until really the last part of this decade. We started talking about building the wall in Mexico and doing those kind of things and taking things back home, which again is not good or bad. It's just the way that economic policy works, because there's arguments for and against both. So the picture I have on here is, there's people down here. You see the globe, and they're sort of taking their piece of the globe and going home. And that's sort of what seems to be happening, whether you're talking about the US. And we just talked about earlier, the four of us talked about this whole deal with Intel, the chip making company, Intel. And the government today just granted Intel, I think it was like $8 billion in government grants, plus an $11 billion loan, and then tax breaks of $20 billion or something over time, to have Intel stay home here and make more chips here and make more plants, build more plants, including in Columbus, Ohio, to have plants here to be able to make more chips so that we don't have to buy them overseas. And that's done for security measures and other reasons, of course. Now, what does that do, though? If we're going to make more things here at home, what does that do?
It's going to make prices go up.
Yeah.
So think about just within the past couple of years, you had chip prices. Chip prices were really high because the supply of chips wasn't very big. The semiconductors that were made overseas, you had cars parked on GM and Ford lots because they couldn't sell the vehicles because they didn't have the vehicle was completely built, except they couldn't put the chips in the vehicles because they didn't have any. So if we start building them here, it's not as big of a competition, which obviously just by definition is going to push prices up.
Mm-hmm. Yeah, yep, and exactly. So, so use the car example, Brad. That's a good example. So if the chips are not coming from overseas, by the way, some of the car manufacturers just made it without the chips, certain chips in the cars, so you didn't have an electric, front seat to go back and forth. But if you're going to buy chips now from internal resources that are going to push prices up, that means the price of the car is going to go up, right? Because they're paying more for the car, they're not going to eat it. So they're going to pass that on to us as consumers. So it does push prices up. And again, I'm not making a value judgment on whether that's right or wrong. We just have to be aware of some of the effects of this deglobalization that may be happening, and then what stock sectors or what parts of the economy are going to be favored in those kind of situations. Value stock rotation, we talked about, some other areas of the market. Value stocks, again, are stocks that are not go-go stocks. They're stocks that are products people are going to buy no matter what's probably happening. So Kraft Foods, people are going to buy mac and cheese pretty much no matter what's going on. Matter of fact, they may buy more mac and cheese if things don't look good in the economy, because maybe they don't go out to eat as much. Procter & Gamble makes toilet paper and paper towels that people are going to buy. Diapers, they're going to buy that stuff no matter what's going on. So those kind of companies tend to do well. Those are called value stocks, and they tend to do well, again, in rate cutting cycles, or if you get a slowing economy going on. And then one of our big themes is this whole artificial intelligence. Mark Zuckerberg tried to call it metaverse, and no one liked that term. So he even changed the name of his company from Facebook to Meta, and no one liked that. So he just picked the wrong name. But, metaverse, AI, used to be called virtual reality. Many years ago, we actually started looking at some of these virtual reality companies that weren't the big companies, and we still are. One of our research guys actually looking into that right now for us to say, what are some of the ancillary companies that may come about because of this whole AI revolution that's going on? So like on the iPhones. The iPhone itself, of course, was great for Apple, but all these companies started making apps for the iPhones, chargers. There's all these kind of things that came about because of the iPhone. And those are the kind of things that we're looking at also. Companies we're looking at and saying, what kind of companies would benefit from AI besides just the chip makers and the big, those big companies that are just involved with, some of the semiconductors areas and the software. So, but the application is really enormous for us. And, one of the examples that I like to look at is, say, in sports, and we're here in Cleveland. So, I go to Guardian games or Browns games for football. And let's say Browns, it's a Sunday and it's 5 below zero. We don't want to go to the Browns game, but we could actually put our goggles on, our virtual reality goggles, and put our haptic suit on and actually sit down on our couch and be like we're actually at the stadium, at the game. We can smell the peanuts and smell the smells of football, while we're there. It would feel like you're actually there, but you're on your couch, and you could even dial up your haptic suit if you wanted to have it 30 degrees if you wanted to. And it wouldn't cost you $100 for a ticket. Maybe the Browns would charge $20 or $15 to go to the game on your couch. So those are the kind of things, though, to us, we look at it and say, I guess, why wouldn't that happen? But not just sports, business applications. We could be on a Zoom call. We could say, hey, let's go to France and do it in the virtual world. There's all kind of things that are applications that we look at and say we think is going to happen down the road. Now, it doesn't happen right this second. It doesn't happen in 6 months, but if we're looking at over a number of years. So we're a big believer in that, and we do, believe in the companies that are going to be all part of that AI revolution. Any other comments, guys, on the things we just talked about? AI, deglobalization, value stocks? Because we've kind of reached the end of our call here. Paul, any last comments you have, Paul, before we sign off?
Yeah, just a reminder that we're always available. You can reach out to us anytime you have questions on your account or want to discuss your goals, don't hesitate. We're here. We'd like to hear from you. And any feedback you want to give us on these presentations to see if they're helpful, if there's something else you'd like to see, that would be good too. Beyond that, I want to thank you for joining us, and we'll see you next time.
Thank you.
Thank you.
Thanks. Have a great day.
Bye-bye.